Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Jack Miller from Gelt Financial. This is one of the most creative hard money lending companies in our network. They lend mostly on commercial real estate, but smaller deals under $2 million. They could sometimes go up a little higher, but most of their deals are under $2 million. They can do a lot of loans that other lenders don't, and it's also due to their capital structure, and they have that flexibility to get very creative. So in this interview, I asked Jack to share his thoughts on what's happening in the market right now. We talked a lot about their loan programs. He shares a lot of different loan scenarios or examples of loans that he's funded, which I appreciate, and he's got a lot of different stories and a lot of different structures that they've done. We talked briefly about their company, their capital structure, their in-house loan servicing, and we finish off by talking about the different markets that they've been lending in the last year or so. They do lend in a lot of the eastern states, the Midwest, the South, so basically most of the country except the western states. We've had a relationship with Gelt Financial for many years. I've visited their office in Boca Raton, Florida. Jack's a good guy. He runs a great shop, and they do a lot of good work in our industry. I hope you find this episode to be insightful. Let's get started. Here's my interview with Jack Miller of Gelt Financial. All right, Jack, thanks for joining me to talk about Gelt Financial. And how's everything going with Gelt right now in May 2025?
Everything's going great. Thank God. It's always great to see you and to talk to you and to be with you and to talk shop. I love what I do. It's one of the passions of my life to talk about the mortgage business and private lending. So, I get turned on by this kind of stuff, by exchanging ideas and learning. So it's fantastic.
Me too. I love talking about it, and I love what you guys do. So glad to be talking about it a little bit more. So first, let's start off with whatever you're hearing in the industry as far as trends, or what are some of the different things that you're hearing from real estate investors, or some of the things that are driving loan requests over to you?
The past immediate period of time, we've been seeing what I call have to do deals, not want to do deals. The deals we're seeing is, foreclosure bailouts. We just closed, actually today, $1 million loan on a Walgreens in Staten Island. The guy needed money for income taxes. So it seems that most of the deals we're doing now are what I call have to do deals, partnership buyouts, divorce buyouts, just all kinds of things, or a lot of balloons with other lenders and other banks that are pushing them off the books. We're not seeing a lot of, opportunistic deals. And I think, to be candid with you, investors are missing the boat with that. So we're seeing a lot of have to do deals. Conversely, what we're seeing is borrowers, good quality borrowers, are having a hard time getting deals done at banks. Banks are taking longer. They're being more stringent. I hear all the time from borrowers, we're going to pay you off in 2 weeks. 2 weeks comes and they call up, the bank or the lender, forget it. They told us to forget it. So a lot of gyrations in the market, a lot of nervousness in the market. We've been doing well because we have the capital, and we don't sell our loans. We're not dependent on a secondary market to fund them. So we've been doing well, but I see a lot of tension in the marketplace right now.
And as far as the tension, is that are you seeing a lot of maturity defaults, or are there other types of defaults that you're seeing?
All kinds: maturity, payment, technical defaults, just everything. Fairly recently, a particular bank in a particular state didn't want any more gas stations. So they put literally I don't know how many gas stations in default. We wound up doing 4 or 5 or 6 of them. And the bank referred them to us. They were all great, but the bank just made it an internal decision. Their allocation for gas stations was too much. They weren't renewing any of them. They terminated a bunch of them. So, it's just a weird market, but thank God we're able to pick up the pieces when other things happen, when either borrowers get in trouble because of a foreclosure. We just closed the deal, I think yesterday or the day before, a major city in the South, owned by a high net worth guy. There was a fire in it. He got into a disagreement with his mortgage company over the proceeds. He took a firm position. They put him in default. They started foreclosure, and we provided him financing to pay them off. So all kinds of weird situations.
And as far as banks go, are you seeing other trends with banks instead of, let's just say it's an allocation to a certain asset class? Are there other things that you're seeing being pulled back with banks?
Yes, 100% good question. What we're finding is it's taking them longer to get an approval, and it's harder to get an approval in terms of the documentation, in terms of the debt service, in terms of values, in terms of everything across the board. Banks are being harder, and it comes from the federal regulators. They're being harder, and it opens up more people that they can't go to a bank.
And your logo, or I'm sorry, your tagline is when banks say no, we say yes. But Gelt's lending is even more flexible than a lot of private lending companies or hard money lenders that I've known over the years. So you're doing a lot of very creative structures, and you're considering borrowers with unique situations and not so great financial situations as well. So it's interesting how it's you get fallout from the banks, but also from other private lending companies, I'm assuming as well.
100% we do. Yeah. A big source of referrals is other, I don't want to say competitors. I'm pretty friendly with most of our competitors, or a tremendous amount of them. We have very, very good relationships with, and they're always referring us deals that they can't do. The reality is most companies are selling their deals on the secondary market or to a warehouse line or something of that nature, that they don't determine the guidelines themselves. It has to be within a box. We're not that way, so we have more flexibility.
And I'm going to come back to your capital structure later on, but why don't we start talking about just your general lending guidelines? From what I know, you're lending mainly on commercial real estate or smaller commercial real estate deals, even though you do residential deals. Could you tell us a little bit more about, let's say, the loan amount ranges and the loan to value and interest rates and things like that?
Yeah, 100%. So generally we go from 50,000 to 2 million. We're thinking about upping that and coming up, doing what we call a core plus product from 1 million to 5 million, because we have the capital sources for that. Different underwriting guys, but the average loan in the Gelt portfolio right now is, I think, 411,000 that I looked at a couple weeks ago. So it's about that. So we're doing smaller loans, mixed use properties, a good amount of residential investment properties, self-understood, not owner occupied, retail centers. We love retail. We have a bunch of credit tenant deals in the books. We just closed today on a Walgreens in one of the biggest cities in the country. Very smooth borrower, but he just needed $1.2 million quick. He couldn't wait to go to a bank, so he came to us. We have a ton of credit tenant deals on the books, and we do a lot of 1031 exchanges that the people have most of the money, but they're a little bit short. And because of the 1031 time limit, they need to close very quickly, and a bank's going to take longer. Mixed use, all kinds of properties. We don't do new construction or land or heavy lifts. In terms of terms, we're generally, a year to 3 years. Sometimes we'll go out 5 years, but we're generally short-term lenders. Having said that, I think, I don't know the exact number, but I think it's 40 something deals have been on our books more than 20 years. So even though we're doing a year, 2 and 3 year terms, we have over 40 loans that have been with us for more than 20 years because we keep extending them. We'll put them on a 5-year extension or a 3-year extension. As long as they're paying us, we're fine with it. In terms of rates, today we're give or take 12%. I think probably 90% of the deals are 12%. If it's a real small deal, we'll go higher just because it's so much work. But, a decent sized deals, that's where we're at today.
And what about the fees? What's your typical points and any other typical fees that you charge?
Yeah, good point. 3 points. We're generally interest only. We're generally floating rate, but we can do fixed rate. We have the ability to be very creative with our terms. So we win some deals for our creativity in structuring deals. And we can just do that because, again, we're not selling the loans.
Most of them are, or all of your loans are first position.
over the years, we've done some mezz and some seconds. To be blunt, we're trying to stay away from that the past year or so. Once in a while, we'll do it, but we're not doing high leverage seconds. I know there's a lot of people say, oh, you're doing seconds. The bank's giving me 75. Will you lend me another 20? No. The seconds we're doing is like we closed one, a property was worth, let's say 10, 11 million. I forget. It was like a 3.35 first. And at a very low rate, they needed like 500 grand, but they didn't want to pay off the first because it was a super low rate. But we were super low on the leverage on the capital stack. So we did that. So, we're doing low leverage second and mezz, but not the typical high leverage to bridge the gap.
Okay. And speaking of leverage, what's your typical loan to value for most of your deals?
Generally it's 65%. In some of the high growth states, the Carolinas, Florida, Texas, Atlanta, things of that nature will go 70, 75. And we've actually done some deals up to 80 and 85 under slightly different structures, either JV structures or some sort of partnership structure. We've actually go up to 100% on JV, but on a straight loan, we've been able to get up to 70, 75, 80 on some deals in high growth state if we get a little creative.
But on your typical deal, let's say it's a purchase bridge loan or a refinance bridge loan, are
65.
you around 65? Okay.
Yeah, as a general rule, 65.
Okay. All right.
And another thing, I apologize for selfish plugs, but whatever, I have to. We don't do appraisals, so it saves the borrowers a ton of money and a ton of time.
And how does the valuation work? Are you just looking at data on your end, or do you have to do a site visit or BPO?
So what we do is we definitely do. We have an inspection company that I think charges $175 or something like that to do an inspection. We do what we call an internal evaluation. I have an analyst here, and it sounds pompous when I say it, and I don't mean it to be, but I think we can take any property in the United States and come up with rental comps, the expenses, sale comps, all within a half hour, an hour, as accurately, I would argue more accurately than most appraisers from a lender side. So we do internal evaluations.
Okay, and let's talk about geography. I'm assuming you're lending only in major metropolitan areas. You mentioned some of the southern states. What other parts of the country do you lend in?
So we lend in, I think it's 36 or 37 states that you don't need a license in or a home state. Unfortunately, we don't do California, Nevada, Arizona, Alaska, Hawaii, the Oregon, the Dakotas, all the same states as everyone else. But we're not rural lenders. So we're urban and suburban. We generally like the cities to have 50,000 people. Once in a while, we'll go to 25,000. Once in a while, a little smaller if it's close to a big city. But we like population. We like population.
All right. And let's talk about the property types. What percentage of the loans you're doing are secured by commercial real estate versus residential investment properties?
Last I checked, I think about 25% of the deals were residential and the rest were commercial. I'm taking out our niche of association loans because they're not secured by any type of real estate. So I'm taking that out. But I would say it's about 75% commercial and 25% residential. And the commercial's really all types of commercial.
Can you give us some examples of let's say, the types of commercial properties that you won't consider?
Yeah. So, we don't do anything specialty, an ice skating rink, a bowling alley. We're not doing, huge warehouses of hundreds of thousands of square feet. We want it where if, God forbid, something happens to a borrower, we could call up a local realtor, rent it out easy, or sell it easy. So, mixed use stuff, flex space, things of that nature, things that are easy to lease out and or sell.
Okay. Well, how do you feel about hotels?
We've done some. If it's the leverage is right, for whatever reason, we did 3 in a row in Branson, Missouri, like 2 years ago. Sort of all of these 3 got into trouble with COVID, and we helped them. Effectively, all of them were bailouts. We helped them. They all paid us off. So if it's the right deal, the right leverage, absolutely.
And you mentioned gas stations earlier. Is that something that you like and you want to do more of them?
Absolutely love gas stations. Again, it's LTV based. We have to have a realistic understanding of the value of the real estate, knowing that gas isn't going to be more. I don't want to. I don't want to get political, but electric cars are making an impact. So the going to a gas station is going to be less. I'm assuming it's going to be less and less in years. We like them because they're generally in fantastic locations. They're corners. You can repurpose them pretty easily. So if it's a good LTV, but like on a gas station, we're generally going to be a 50 LTV.
Okay. And what are the most common commercial property types that you're funding? Is it retail, industrial, automotive?
We do a lot of mixed use, apartments upstairs, a pizza place downstairs, that we do a ton of those. And we do a ton of retail, small strip centers, 3 stores, 10 stores, 20 stores. We're very comfortable with the retail strip.
And how about multifamily? Have you done a lot of multifamily property loans lately?
Yeah, sure. Multifamilies are very competitive, but absolutely, we love multifamilies.
Okay, great. And are most of the loans that you're doing, are they a purchase or are they more refinances?
We do more refinances. I think it's probably 70%, 80% refi. The past year or so, a couple years ago, it was more of a 50-50. But in the past couple years, it's been more refinances.
Okay. Let's talk about some of the unique loan structures that you've done. Let's start with something a bit more basic. Let's talk about a foreclosure bailout situation. That's obviously a refinance, but let's say there's a borrower that's received a notice of default, and then they're getting close to going into foreclosure and auction. What are some of the requirements that you'd have if you're going to do a refinance for one of these properties, aside from assuring that there's enough equity in the deal where the loan to value is no more than 65%? What else are you looking for in that situation?
We're hyper focused on the collateral and not as focused on the borrower. So most of the foreclosure bailouts we do, and we're doing a lot of foreclosure bailouts, a good amount of it is our business. The properties are strong. The borrowers, something happened for different reasons. And we're dealing with the property. Again, we're not really looking at the borrower's credit, the borrower's income, or things like that. We want to be hyper focused on the property.
And if let's say it's a payment default, are you doing further checks onto the financial part of the equation as far as whether they're going to be able to pay you if they're not paying the current lender? How do you deal with that?
Yeah, every case is different. If it's a payment, we'll ask them why. We have to get a story feeling comfortable. On rare occasions, we've required them to enlist the services of property management. If we think they're bad landlords, they just can't deal with it. We've said, go get a property manager, have them pay us, have them collect the rents, and that's work. So each case is a little different. But it's like, we try to set them up for success. We don't want to make a loan setting them up for failure, saying, oh, in a month, they're in the same position, or in 2 months, they're in the same position. So we want to have a path, at least we think, is plausible.
Okay. And let's talk about foreign nationals. Are you okay lending to a non-U.S. citizen?
Absolutely. We do it all the time. It's a good percent of the business. Absolutely.
Nice. And are there any other requirements that you have for a non-U.S. citizen in order to lend to them?
Not really. Obviously they can't be on the OFAC list or any of the bad guys list. We don't want to lend money to terrorists or anything like that. Once in a while, we've had them engage an attorney to accept service. If we were concerned that, hey, they're going to disappear to China and we'll never be able to serve them to get it, we've had them sort of pre-do that, have an attorney represent them. But that's really it. And we haven't had any resistance to that.
And are you a little bit more conservative on the loan to value for a foreign national versus a U.S. citizen?
Not really. It really doesn't for us, because we're collateral based. We're putting 95% of the decision in the collateral to begin with. Whether the guy lives next door to me or, he lives in California or New York or anywhere, we're looking at the collateral. We're really not focusing on the borrower's credit or the borrower's income. We look at it, but it's sort of, we don't put that much weight on it.
And speaking of that, let's talk about some of those requirements or the underwriting that you do on the borrower themselves. So it sounds like you don't mind if they have a low credit score, if they've had, let's say, a bankruptcy. Tell us a little bit more about what you accept and not accept for as far as a borrower finances.
Yeah, all of that is fine. You know, we've done, believe it or not, I've seen credit scores, you know, in the low fives. I think we saw one 485 at one point, something like that. But we're fine with that. We're not focusing on that. It's just an interesting tidbit. You know, we're not really focusing on the borrower's employment. You know, we just have to take it into consideration. Like, we'll sometimes get bank statements. If there's like everything is an NSF check, we say, oh, you know, what's the problem here? And we'll say to the borrower, hey, you got to get a separate bank account just for us. So we're not making decisions based on that. Again, it's based on the property. It really is. And that's why borrowers generally are coming to us, because we're laxed in that area.
And with that, have you had to deal with a lot of foreclosures or defaults from your side?
Not really a lot. You know, we're a fairly small company. I think there's 13 or 14 of us in the office. So we're not serving, you know, it's not like some bureaucracy where you don't know your borrowers. So if a borrower gets into trouble or something bad happens, if they call us and communicate, 99.9% of the time we can work it out. In fact, I don't remember ever a time a borrower who's in communication, it got ugly. Where it gets ugly is when they don't return your calls, they stop communicating, or they, of course, you know, they blame somebody else. It's your fault that I'm behind, or, you know, but most of the time, it's pretty smooth. Now, that's not to say borrowers have problems. Tenants leave, properties burn down, people die, people get laid off. We've had it all happen. But if they're responsive, you can work with them. So if the payment's $4,000, you know, maybe you have to give them a 2-month agreement, a modification, take it to $2,000 or $1,000 or whatever it is. And we did a lot of that in COVID. But if they're willing to work with us, we're going to meet them. We don't have to be 50-50. We'll meet them 90% of the way. We just want them to return the call. If they don't give us the middle finger, excuse my language, it'll be great. We'll work with them.
Love it. Let's go into this association loan program that you touched on earlier. So tell us about this. This is for multifamily or condominium associations. Can it be for commercial as well?
100%. So many years ago, probably 20 years ago, we started to do some loans to condo and HOA associations. And it's interesting because there's no real estate collateral and there's no personal guarantee. We're lending the association money, usually for capital improvements. Now, for a long time, we didn't do many of them because it wasn't a big market. But unfortunately, a couple years ago, there was a calamity, a terrible tragedy in Florida where I think a lot of people died, and it was terrible. A building just collapsed in the middle of the night. And that caused certain states to change their laws where the boards can't kick the can down the road for capital improvements. So the past 2 or 3 years, we've been doing a ton of association loans all over the country. You know, literally Washington State, we just closed one, when I say just, I think 2-3 months ago in Arizona. It was a co-op. It was our first co-op. We lent them, I think, $450,000 on a 90-unit co-op. So we're doing association loans all throughout the country, and I believe we're one of the few lenders, non-bank lenders, who are doing them.
I haven't heard about this myself in our space. So tell us how it's possible. What's your collateral if you're saying that the property is not the collateral?
There's no mortgage. There's no mortgage. It's a promissory note and a UCC from the condo association. So picture a condo association. Let's say it has 100 units. Each unit's worth $300,000. Maybe they want to borrow, you know, let's say $1 million, just for a round number, $10,000 a unit. So again, no personal guarantees because the board comes and goes, and no real estate. So if, God forbid, they went delinquent, what we would do is we would put in a new board, put in a new management company, pass a special assessment, raise the dues, and pay ourselves back.
So it's a UCC filing, which is sort of, for people who don't know about that, is more kind of a lien on the business
That's
assets,
correct.
right? The company,
That's
not
correct.
not the
It's a
real estate.
public notice that we're in first position on the association.
Got it. And for these types of loans, do you have any sort of restrictions as far as the size of the property or the types of capital improvements that are being done?
So again, we focus on deals under $3 million, so we're not doing the real stuff. On this, we do focus on the financial statements of the associations. We're looking very closely at it, opposite of the real estate loans. And there are, the big reasons that most associations aren't being done by banks is banks want managed associations. Some of them are self-managed. Banks want typically 25 units or more. We'll do smaller. Banks want a certain percent owner occupancy compared to investor. Banks want what they call payment shock. The payment doesn't go up more than a certain percent. Banks want reserves as well. A lot of condos are not on the Fannie and Freddie list today, so they're blackballed from getting loans. So the individual condos are, as well as the association. So there's probably 8 or 9 reasons that a bank won't do it. And most of them will do. But there are some that we don't do. Once in a while, we'll see some that we don't do, but very rarely.
And let's talk about co-ops versus condos. Is there any issue on your end as far as lending to a co-op versus a condominium?
No, we just don't get that many requests for it. We just closed our first one, and it went super smooth.
And co-ops are more popular in New York City. There's a few I know of in San Francisco. Are they popular in Florida?
Not that I know of. I don't know that we've received the one that we just did was in Phoenix. And I don't know that I don't remember ever seeing a co-op deal come in the door here. So I don't think they're popular in Florida, but I'm not sure.
Whenever I hear co-op, I always think about New York City. It's just
that's
Manhattan.
what I think of too. That's what I think of too.
Yeah, nice. Okay, let's talk about non-recourse. Are all of your loans non-recourse, or in what cases are you non-recourse?
No, most of the loans are recourse. We start off from a recourse position. If a borrower requests non-recourse and we like the property and the leverage is good, we'll do it. I'm guessing 10% of the loans, 20%, probably less than 20% are non-recourse, but certainly we'll look at it and we have no problem doing it. No problem. Again, we're looking for a better property. We're looking for better collateral. We're looking for, just a cleaner deal. If it's a foreclosure bailout and the guy says, hey, I didn't pay this guy, I want a non-recourse loan on this, we may find a way to do it, but we'll just look at it a little differently.
And with non-recourse, typically whenever I see a non-recourse loan request, it's because of the entity structure. Do you have any thoughts about, let's say, do you lend to a nonprofit, for example, where it's not really possible to do recourse?
Well, we really don't lend to nonprofits because, to be honest with you, we don't want to take the reputational risk. But there are some where you're right. There's different partners, and it's hard to get recourse. We closed. Give an example. A simple deal, but a complex deal. It was a cannabis retail in New Jersey. It was literally 100 partners. They raised money from all these people, and it was no recourse. But we were at such a good leverage position, we didn't care. And there was another guy we did fairly recently. When I say recently, 6 months ago, beautiful office condo, a 30 LTV deal. The guy was a doctor, but not the kind that sees patients. He was like a medical researcher who worked for pharmaceutical companies. Good guy and beautiful property. He just said, I don't want recourse. I don't want you to ask for anything. No bank statements, no nothing. We did it because we were like a 30, 40 LTV. It was such a nice property. We figured we have nothing to lose.
And what LTV would you say is kind of the threshold where, hey, if it's under X percentage LTV, then we'll definitely do non-recourse?
I don't know that you can do that because it's a type of property. We've done them, believe it or not, at 70% on credit tenant deals, on 1031s, and things of that nature. So it's not just the LTV, because that's even higher than our 65. But I think this was a Burger King. We did it in Kansas City for. There were like 5 partners doing a deal. It was a gorgeous property. And we felt we couldn't lose on it. If they all, I don't wish anyone any harm, but if they would have walked away and said, here are the keys, we would have been thrilled at 70%, So I don't think it's just the LTV, because certain properties, we wouldn't do it at any LTV, more of the more challenging properties.
And speaking of entities and with multiple investors, a few years ago, I remember you told me about some loans that you were doing where you're lending to the borrower's interest in a particular property. So if they own, let's say, 25% of a property along with a few other investors, you were lending up to, let's say, 50% of their interest in that property. Is that a loan that you're still doing today?
Cautiously, but yeah, absolutely. If a guy or gal or anyone owns a minority non-controlling interest, I always say, let's say they invest in a Walgreens or a shopping center, they own 20% or 10% of it. They have no control over what's happening, and they need liquidity. We'll either buy it, we'll make them an offer to buy it from them, or lend the money on it if it's the right deal. Absolutely, we'll do that.
Nice. And let's talk about JV deals, since you mentioned that earlier. What types of joint venture deals are you doing? Tell us a little bit more about some of those that you've done.
First of all, I have to tell you, I love them. If it was up to me, I would do only JV deals. So look, I'll give you some examples, but we see anytime there's a good property and we could add value to it and help out someone, we'll do it. I'll give you an example of a deal we quoted out yesterday. Guy was buying a small strip center. It was heavy value add. He had very little money, literally not even enough money for closing costs. He called up. I think he wanted and by the way, the amount needed for the rehab was probably 70% of the purchase price. So he didn't have any money, but it was a good property. So we said, I'll tell you what, we'll put up the money. We'll do it as a JV. We'll lend the entity money. You control it. Give us a piece of the ownership. And when it's stabilized, take it to a bank and pay us off. So we'll definitely do that. We'll do that where we put up the first money, all the money, or we've done them where they'll go to a bank, get the first from a bank, and we'll put up the equity money and get a piece of the deal, get a pref and a piece of the deal.
Okay, so that's a really interesting structure, and obviously that's what a JV is. But is this something that you're actively seeking out, or is it very selective, where if someone comes to you with a loan request, then you might say, hey, what if we partner on this deal instead?
Yeah, no, we're definitely seeking out. The challenge is borrowers bring us just everything on LoopNet. They see, oh, we want to do JVs, and we do want to do JVs. So they literally copy and paste the LoopNet link and say, would you do it in this one? Would you do it in this one? Would you do it in this one? So if I could buy it on the open market, no offense, I don't need that guy. He or she has to add real value to us. But we're absolutely seeking them out. And if you want, I'll just tell you about 3 very different ones that we've closed all fairly recently. We have a relationship with a few guys in Philadelphia. They buy row homes fairly cheap. They fix them up. We provide 100% of the money, 100%. They don't put up a penny. We get 50%. We get 50%. They get 50%. I think we get like a 10% pref on it. And what happens is, then when we buy it, we fix it up. They rent it out, wait 6 months to season it. They'll refinance it. We're usually getting most of our money back, and they manage it, and we stay in. And obviously, when they borrow money from a bank or a DSCR loan, we're in. So we love that. We're fine with accumulating these. Another group, coincidentally, a suburb of Philadelphia again, they found a small shopping center, kind of a mixed-use property, had a bunch of different things, but it was on a corner location coming out of a major mall. And they put it under agreement of sale. We provided 100% of the down payment. They went to a bank, they got 70% financing. We provided the 30%. We provided the closing costs, plus another 150 grand for CapEx and reserves. Again, we got a pref and we split the deal. Another deal, a guy, long story, he had a tenant, he found the property, he put it together. On that one, there was no first. We put up the first, and again, pref 50-50, and then ultimately we bought him out. He wanted the cash to buying out. So we're 100% love JV deals. Call us with them. I want to hear them. But they have to be something more than, oh, I could just look on LoopNet and buy them. There has to be something there.
So it's got to be an off-market deal, or they have to have some relationship with the seller.
Yeah, or something. You know, when people call and say, will you do JV on this? Did you make an offer? Did you see the due diligence? And they say, no, you approve it first. You know, the problem is, I don't mean to say be rude, but if I spent forever, if I have my staff just underwriting deals all day long without the local partner looking at it, we wouldn't get anything done.
Sure, makes sense. And it sounds like with these JV deals, I mean, there's a big risk that you're taking. How is it possible that you're able to take on that amount of risk? Let's say something goes wrong, the sponsor or the partner that you have just walks away. Do you have the ability to easily take over these projects and complete them?
You bring up a very good point. So our rule is we assume every borrower, and this is terrible to say, and I don't know how else to say it, but this is what we say. We say if the borrower gets hit by a bus 2 seconds after closing, what are we going to do? And if we're depending on that borrower not getting hit, or JV partner not getting hit by a bus, we won't do the deal. We need to feel comfortable stepping in their shoes to hire a local realtor or local property manager to fix up the property or sell it or whatever. So yeah, if we're not comfortable with it, we won't do the deal.
All right. Okay. That sounds great. I want to jump into talking about the company and your capital, but let's take a quick break and we'll be right back. Support for the show comes from Ross Diversified Insurance Services. All real estate investors and all private mortgage lenders need insurance. More specifically, they need the right insurance partner. For over 35 years, Ross Diversified has been the trusted partner for over 3,000 property investors and 500 lenders throughout the United States. If you're a real estate investor, Ross Diversified can help you whether you're managing a single rental property or a large portfolio of rentals. And if you're a lender, Ross Diversified can protect you with force-place insurance for when a borrower's policy lapses, or with REO insurance in the case of a foreclosure. They offer competitive rates and hassle-free claims assistance. Licensed in all 50 states, Ross Diversified understands the unique challenges of real estate investing and provides customized solutions to safeguard your assets. Visit their website, rossdiv.com, to learn more and request a quote. That's ROSSDIV.com. Please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with Jack Miller and Gelt Financial. So, Jack, tell us a little bit about the company. I know you guys have been around since 1989, so you've been at this business a long time. But tell us about the operation, where you're located, how many staff you have, and more, whatever you can tell us about that.
Yeah, sure. I started the company February 1st, 1989. We're in Boca Raton, Florida. We've been in Florida. I moved to Florida in 2006, and we started to move the company down. So we've really been effectively here since probably about 2011, 12, 13, something like that. I think we have 13, 14 people in the office. We have some remote people. And, we're an interesting company because we don't have commission loan officers. No one in the company gets commission or bonuses for doing deals. So we don't really have any sales organization. Everyone's sort of, or the frontline people are sort of a combination of loan officers, underwriters. They do a little bit of everything. So the culture's a little different than most companies where you have underwriters, loan officers, processors, wholesale reps. So we have a little bit of a different culture than most companies, but it allows us, why we do it this way is it allows us to close loans quick. Most of the deals we're doing, or a lot of the deals we're doing, they're coming to us for speed. Someone else dropped the ball. Lately, it seems it's all the time. Someone else dropped the ball. They'll call us on a Friday and say, oh, we were supposed to close Monday and whatever. They're not returning our calls, or it was a bait and switch or whatever. and we close the deal. And usually, we can get it done. We've done them as 3 or 4 working days, but the average is 6, 7 days. And most of the time we can close quicker. It's the title that's the holdup, or if it's something else that's a holdup. But our structure allows us to move very quick to a closing.
Yeah, so long as the property has enough equity is really
Oh,
the key.
100%. Look, one of the things that I have here, we have an analyst who is full-time, and all he does all day long is analyze real estate all over the country. And that's critical. That's one of the first things we do.
And one thing I forgot to mention earlier is with cross collateralization. It sounds like you do a lot of deals where you're crossing multiple properties to make the LTV work or the deal make sense.
100%. And a great example of this, and it happened a couple of years ago, but it happens all the time. Someone calls up and they wanted to borrow, I forget the exact amount, let's say 400,000. And they were buying a property for 400 grand. And I think they were buying a property for 400 grand. They wanted to put like 10% down. So I'm speaking to the mortgage broker, and the guy goes, "Oh, the guy owns like 3 or 4 properties unencumbered." I said, "Will he let us pledge it?" He goes, "Yeah, no problem." So the bottom line is we lent this guy like 425 grand or 440 grand for the closing costs. We took the property he was buying, and we took an existing property, which was worth about that. In our eyes, it was a 50% LTV deal. All day long it was a 50 LTV. In the broker and the borrower's eyes, he got 100% LTV. So we do blankets a lot. We're not scared of it. If borrowers have equity in a property, they could use it as additional collateral.
And is there any case where you're able to take a second position as additional collateral?
100%. Sure. Again, you have to look at what the first mortgage is. Is there an intercreditor agreement or not? But absolutely we do that.
And does that vary depending on the state as well, according to state laws, if you would take a junior lien?
Well, you have to be careful because in certain states like Texas, they don't have to give the second mortgage notice of a foreclosure. In a judicial state, New York, New Jersey, Pennsylvania, Ohio, it takes a long time. So you just have to be a little careful. Absolutely. The reality is, and I think unfortunately, the state laws and how the state treats lenders from a legal perspective has a lot to do with underwriting today. People may not want to talk about it, and it may be taboo to talk about it, but it does. And I can tell you, when I speak to peers in the mortgage business, they're talking about it.
Okay. And as far as your company goes, you're doing these really creative loans. How is this even possible? What's your capital structure? What's the capital behind Gelt Financial?
Yeah. So why we can do it? Because we have no debt. We have no bank debt, no debt, period on the books, zero. We are funded either our own, it's a combination of our own capital as well as high net worth investors and individuals or family offices or groups. So our partners who fund us, they don't have a manual. Oh, it has to check off this box. It's a common sense thing. So when we look at deals, we try to use a common sense approach, and our capital is very common sense approach. And that's why we have not a lot of foreclosures. That's why everything, because we're not under pressure from capital. Oh, the loan matures, put a gun to the guy's head. And if he doesn't pay you, put him in foreclosure. We don't operate that way. So it gives us the flexibility. Now, internally, between me and you, my capital is a lot more expensive than a bank line. So my margins are less than most of my peers. I've made that decision. I'd rather have that flexibility than the additional profit, just because of my personal situation. And I've lived through bank lines before, and I got beaten up by them. I saw what they could do to you. So I'm happy with paying a little more to private investors and family offices, self-understood accredited investors, but because that gives me so much flexibility.
So do you typically have one loan that's divided up by a few different investors or fractionalized with a few different investors?
It's all different. It's all different. So, we closed the loan today. One investor took it. We closed a much smaller loan yesterday. I think 4 or 5 investors, fractionalized it, took little pieces. One guy put up 100 grand, one guy put up 50 grand. It really all depends on the deal.
And at this time, do you tend to have more capital than deals or more deals than capital?
You asked the $64,000 question, and it's always a hard balance for me. I probably shouldn't say this, but it's the truth. I'm driving on the street, you're driving on the turnpike or whatever expressway it is, and some days my foot's on the gas, some days it's on the pedal, because if I have 1,000 great deals that walk in my door tomorrow and I don't have the capital for it, I'm in trouble. So it's always a balance. I'm always juggling that. That's the problem of the company, to be blunt with you, that it's not an even mesh, but it's always a juggle and a balance.
And what you mentioned about the cost of capital being higher is typically when you have these individual high net worth investors, they have a certain return requirement where it's higher than what let's say a bank line would charge.
That's correct. I'm paying up for there's a lot of benefits to them, but it's costing me a lot of money. No question about it.
And as far as the loan term, typically from at least what I've seen with high net worth investors is they don't want the money to stop coming in. They don't, a loan payoff is a bit disruptive because then they stop getting their return, and then they have to wait for another deal to come along that they could invest in. So it sounds like that's one of the reasons you're able to do longer terms and let the borrower extend way beyond the maturity date if needed, right?
Yeah. So I believe the number's around 80% of our deals take extensions. And we are, again, as long as they're paying us, we're fine extending them 3 months, a year, 3 years. I'm looking to keep it going. When we get a payoff, I'm glad for the borrower, but I'm not jumping around of joy because now I got to put it out again.
Sure. And so from the borrower's perspective, if let's say Gelt Financial funds their loan, it's the capital behind it is a combination of Gelt's capital plus some high net worth investors. It doesn't really matter to the borrower, right? Because Gelt is servicing the loans and dealing with the borrower throughout the term, right?
That's correct. Look, I'm telling you because I know you. We're friends. We've known each other a long, long time. You still have your hair. I lost mine and I got gray, but you have the good genes. No, because it's the truth. But if I wouldn't volunteer the information, and by the way, our borrowers and brokers have no idea. It's not their concern. It's all behind the scenes. All behind the scenes. All of our investors are 100% passive. They're not involved in anything. So yeah, the borrowers, doesn't matter to the borrowers.
I guess the reason I ask is typically, people want to know, hey, are you a direct lender? And then not that everyone understands what makes a direct lender, but that's the only reason I bring it up, is just to explain to the people who do know about how private lending capital works. They want to know, hey, where's the capital coming from? Are you going to have enough, or what's the situation after the loan funds as far as dealing with the lender?
Yeah. So the way we work is just for timing, we generally fund the deals ourselves. And then after it's closed, we'll go to investors and say, hey, I have this loan. Do you want a piece of it? So we're not dependent on investor money to close a deal.
Got it. That's amazing. So that makes it more efficient. You could just make the decision, close the loan. You're not trying to raise the capital.
Yeah, and we don't need to raise the capital. We're very lucky. Our investors have been with us, not years, but a lot of them decades, literally. And a few of them were on the second generation. We started out with their fathers, and unfortunately they passed away. So now we're dealing with the siblings, the kids. And we have, I don't remember the number. I think about 115, 118 active investors. So we're not trying to raise money. Let me back up. We're always looking for new investors, but we're not doing a deal for 400 grand dependent on finding an investor. We're funding it, and then we'll lay it off, later on.
And as far as the servicing goes, for people who don't know much about the servicing, it's essentially where you control all the dealings of the loan, from the funding until the payoff, right? Where you're collecting the payments. If any borrower has any issues, they're contacting you, and you deal with workouts. Have you always done the servicing in-house from the beginning?
Yes, we fairly recently outsourced some of the mechanics, depositing the checks, paying the taxes, paying the insurance to a servicing company, but we still deal with delinquency, workouts, modifications. We deal with everything except, literally the deposit and the payment of the taxes and insurance. Just to be candid with you, it was cheaper to outsource it than to find people to do it internally. But yeah, we've always done it ourselves. In fact, we actually service some loans for some other people.
Interesting. And I remember a long time ago you were looking at acquiring loans from other lenders. Is that something that you still do?
Yeah, absolutely. We're always looking, and we're buying. Mostly it's non-performing, but fairly recently we bought a performing loan from a company in Connecticut. It was a nice deal. It was in New York. Whatever, they had problems with one of their investors. They needed to sell it. We were thrilled to buy it. So absolutely, we're looking to. Our situation is we don't have a sales organization. So I need to find alternative ways to deploy capital. We have more capital than we can have the deals for. So buying either performing debt or sub or non-performing debt is a great way to do it.
And as far as non-performing debt, so let's say a lender has an issue with one of their loans, they sell to Gelt, because you have the capital and then you have the servicing, you're willing to deal with the workout or go through the foreclosure if needed, right?
100%. We have a staff that all they do is this. Not only this, we have a property management staff. We also own properties all throughout the country, so we can manage properties very efficiently all over the place. So we have a complete staff to do all of this. And it's nothing for us to take over a loan. If they're paying, great, but if they're not paying, try to reperform it. We do everything we can to reperform it, and once in a while you can't, and you have to deal with it.
Interesting. And for some of the loans that you've had where they, like you said, they've extended by 5 years times 4, so they've been in the loan for 20 years. In what situation is someone willing to continue paying, let's say around 12% interest for that long? Or are they just never able to qualify for a more conventional loan?
It's an interesting question. I don't have a scientific answer, but I have an anecdotal answer. Some people are scared of banks. I can think of one customer. It's been on the books 20 years, long time, pays us perfectly. And I've said to the guy, and by the way, we give him like 2-year extensions at a time. And I say to the guy, I feel bad. Why don't you go to a bank? His culture, he doesn't want to go to a bank. I'd rather pay you than go to Mr. Jack. I'd rather pay you than go to a bank. They're scared. They're intimidated. They think all these bad things. We're not looking at his tax returns. We're not the IRS. If you pay me and don't burn the property down, we're happy. And a lot of people are that way. And then there's some people just can't get their act together. I could think of other people that should be going to a bank or another company, a DSCR, someone else in between Gelt and the bank. And for whatever reason, they just cannot get their act together. There's always a different story why they can't do it. I don't know. It's psychology. I don't know the answer, but we feel bad for some of these people or all of them and tell them, pay us off cheaper. Pay us off, but
well, it's a rare offering, so maybe they're lucky to have you.
Rocky, I can tell you this, that the amount of gratitude we get from our borrowers is overwhelming. They're so thankful to us and they're so grateful to us. Now, look, they're paying, I don't know what a bank is today, probably 7.5%. They're paying me 12. They're paying 500 basis points higher, but they're so grateful. And they're constantly thanking us, reaching out to us. They feel that they've been dumped on in the world. The banks are breaking their chops. Everyone's giving a hard time. And if they have good real estate, all of a sudden Gelt's closing the loan, even though we're charging them, but they're so gracious and they make me feel so good. I don't want to say every day of the week, but almost every day of the week, I'm hearing from a borrower, whether it be a review or an email. Thank you for what you did. You don't realize how you saved us. You don't realize what you did for us. And it's unbelievable because people think, oh, you're an expensive lender. You're like Tony Soprano. Everyone makes all the comments, but they don't get it. They should be in my shoes, be in this office for just 1 or 2 days, and you'll feel the love from the borrowers. It's unbelievable. It really is.
Love it. All right, let's switch gears and talk about some of the different markets that you lend in. So we have access to Forecasa, which is a really cool data platform where we could see all the different loans that lenders are closing. And from the data we have, it looks like in the past year, most of your loans have been in Florida, Pennsylvania, New Jersey, and New York. And obviously there's a few other states, maybe Texas. But if we could just do a quick run through of each of these different states, and tell us about your thoughts on lending in that state, if you're excited to do more lending or where you'd prefer to do loans, or what markets you're more excited about, I should say.
I'm excited about the growth markets, the southern markets, and some of the growth markets. And that's where we want to do deals. The reality is there's still a lot of deals in, some of the big city, the Pennsylvanias, the New Jerseys, New Yorks, Illinois. We do a lot in Brooklyn, just closed one there today. But it's a challenge in these big cities. We closed a deal. A guy owned, I think, 2 or 3 daycare centers in a suburb of Chicago, and he bought an Aldi's to convert it to a daycare center. Guy's bankable. Guy was actually referred to as, just owned him by his SBA lender who approved him. Super strong guy. This was 4 years ago. He's still not open. He's on the verge of opening up because he can't get the approvals, and it's unbelievable what these big cities do to people. So you have to be a little cautious when dealing with some of these cities and states. Their legal system is a mess. The lender's always the bad guy. The real estate taxes are a fortune, and your 65 LTV could turn into 80 or 90 real quick with 4 or 5 years of real estate taxes. So you have to be careful in some of these locations. But we still do them. You just have to structure the deal differently, have a different LTV.
Well, New York especially is the state that most lenders won't touch because of the foreclosure process being so long. Or obviously you've been in business so long, done a ton of loans there. Have you found that you've been able to navigate it and deal with the drama of New York's foreclosures?
It's a challenge. We were involved with a deal in New Jersey. It took us 5 years to foreclose. 5 years. The taxes were like 20, 25 grand a year. So what we started out was a great LTV. By the end of the day was a total disaster. You have to put on your big boy pants. We underwrite deals tougher and closer in those cities, in New York. If you bring a situation in New York as opposed to Texas, for example, we're going to look at it differently. Yeah, every lender's doing that. You don't have a choice.
Sure. And so in New Jersey, it sounds like the taxes are one of the biggest pain points there.
Jersey is brutal. I have two brother-in-laws and a brother who lives in Jersey. My mother-in-law lives in Jersey. I spent a lot of time in Jersey. Absolutely brutal from a lender's point of view. Court systems are brutal. Just brutal. So a lender, unfortunately, needs to take that into consideration.
How about Pennsylvania? You are from Philadelphia, right?
From Philadelphia. Yep. We're a Pennsylvania company. We still have an office in the suburbs. It's tough. I wish I could tell you it was easy. It's tough. It's brutal. You have to be very careful in those locations. Same thing with Illinois. I have friends in the business. They won't lend in Cook County no matter what. It's totally blackballed because the court system and the government made it that way.
But in Illinois, outside of Cook County, is the rest of Illinois okay to deal with?
It could be a challenge. It's no walk in the park. It's no picnic.
All right. And let's come back down south to Florida. And Florida's had its own challenges, insurance and hurricanes. What's your take on Florida at this time?
Look, it's undeniable the growth that's going on throughout Florida. So we love Florida. Even though the court systems can be a challenge sometimes, high growth states are fantastic because it pushes up values. And Florida's had an incredible population explosion, really. And I don't see any end in sight to it.
And within Florida, are there any parts of the state that you have preferences lending in?
You know, we love in, Orlando and Tampa and South. We have a couple loans in Daytona Beach and the Panhandle, Gainesville, Jacksonville. We just don't know those areas well, and we don't see a lot there. We also have both East Coast and West Coast of Florida. We're fine with. So really, anywhere. Again, Florida can have some rural areas. So we once in a while see a deal. You look on the map. There's nothing there. So you have to just watch where you're dealing with.
And which states or markets are you excited about doing more loans in the next year or so?
Texas, we love Texas. We love the Carolinas. Believe it or not, Idaho, New Mexico, Washington State. We've done very well in Tennessee, Kentucky, Virginia, Maryland, really, we've done well in Kansas City, so it's a mixture. And I don't want to leave out Brooklyn. Is pain in the neck as New York is, we do very well in Brooklyn. There's so many people. It's so dense. So, you just have to bake it in the deal. Lower LTV. You have to bake all this nonsense that you'll deal with if the deal goes bad in the deal.
And some of these states like New York, New Jersey, Pennsylvania, Illinois, where it's a lot more challenging and riskier as a lender, do you typically have a maximum 50% LTV versus a 65, or anything in particular that you target?
We don't have anything official that way, but we have, it's absolutely a lower LTV. We have it's a spreadsheet, and it's a projection. If the deal goes bad, we plug in the taxes, how long it'll take, and we come up with what we're comfortable with, and we use that number. But yeah, it's definitely lower. Again, I think we talked about before, in some of these states, we'll go up to 70, 75 LTV, but in the other states, we want a lower LTV.
All right. Excellent. Well, Jack, that's all I had on my list for today, unless there's anything you wanted to add or anything I might have missed.
No, look, I just want to thank you. You and the website, Private Lender Link, are an incredible resource for the lending industry. You really are. And, I'm grateful for the work you do on behalf of the industry, and looking for a lot more years together. I'll continue to go gray and lose my hair, and you'll stay the same good looking guy. So.
Appreciate that. And
I appreciate your time. The only other thing I want to add is, it seems to me there's always a lot of mortgage brokers coming in the business. For whatever reason, we've built our platform to educate mortgage brokers, and we do a lot of education to our YouTube channel and other ways to mortgage brokers. And that's how we get good graces to mortgage brokers. They don't know what a DSCR is. They don't know how to do an LTV. They don't know what a cap rate is. Some do, some don't. So we educate them, and that helps out a lot. That really does. I also want to add that I think it's a tough time now, and a lot of people aren't doing deals. I think real estate investors are making a mistake being scared, staying on the sidelines. It's sort of like now the stock market came back from 2-3 weeks ago, or as of yesterday, I don't know what it did today, and people are saying, I wish I would have bought that stock at the price 2-3 weeks ago. Why didn't you buy it 2-3 weeks ago? Because I was scared. And I think that's happening a lot now. I think there's a tremendous amount of opportunities now in the marketplace. And I think the smart money is finding those opportunities, and the other people are sitting on the sidelines. And I think that's a mistake for some people.
Yeah, appreciate that. And as far as the educational content, that's quite valuable, because, I've tried to do some educational content myself, but I don't originate loans. I'm not in the weeds. I don't service loans. I've never originated in my life. So I can talk about high level how things work in private money or hard money lending, but to have that really in-depth, education about how things work very specifically is quite invaluable for brokers.
Yeah, if any brokers have any suggestions on different topics, because that's how we've come up with the topics. Someone will come in and say, hey, what's a cap rate? Or how do I figure, a DSCR ratio or whatever? We've made how-to videos on that. So let us know. We'll be more than glad to address it.
Sounds great. All right, Jack, thank you for your time. And it's been a pleasure doing business with you all these years and looking forward to many more.
Thank you, my friend.
Take care. See you soon. And that's a wrap for this episode. Gelt Financial is listed on privatelenderlink.com. They've been on there for many years. I put a link to their profile in the description. Check out their profile to learn about their guidelines and find their contact information. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. I also put a link to Gelt Financial's YouTube channel, which has lots of educational content for brokers and real estate investors. I hope you found this episode to be insightful and informative. I've got a stacked schedule for the summer with lots more great interviews coming soon. Thank you for tuning in and listening to Private Lending Insights.